Welcome to the second video tutorial in our series of video tutorials on fundamental analysis. In our previous video, we discussed the various economic factors that affect the price of various currencies in the Forex markets. In this video, we will be discussing some of the financial and political factors that can drive the price action in the currency markets. Financial factors help measure the financial strength of the economy directly or indirectly. These are tools to measure the strength or the weakness of an economy. Interest rate decisions by central banks, changes in the monetary policy, tax rules are some of these financial factors, to name a few. These factors are critical, and a change in their value may bring a major change in the price action of the currencies involved. So how do we use these factors while trading? It is a good practice to be well informed and aware about the various major news events happening across the world to be able to interpret their likely impact on various currencies. Just like in the case of economic factors, one should try to interpret the financial data or changes made available to determine their expected implications on the economy and its currency. So interpret the changes in the financial data made available to determine its expected implications, and on the basis of this interpretation, initiate trade positions to take advantage of the announcement or the changes made. Depending on whether the data released is positive or negative for the overall economy, there might be major price action. Financial data with positive implications for the economy could cause the currency to strengthen, which could result in an increased buying of the currency against its other peers. Data with negative implications, however, could devalue the currency, which could be followed by selling of the currency against its other counterparts. Some of the major and most widely tracked financial data releases are as follows. Interest rate decisions announced by the central banks of various countries, such as the ECB or the European Central Bank for the Eurozone nations, the Fed for the US, Bank of England for England, Bank of Japan, etc. Also, any monetary policy statements or the economic outlook reports released by these central banks, or any other decisions or actions taken by these banks of various different economies, or any press conferences or meetings held by the financial heads such as the G20 summit or the Jackson Hole Symposium or the ECB press conference are some of them, to name a few. We will now be discussing each one of them and how to use them while trading. Starting with the interest rate decisions made by the central banks of different countries. Interest rate decisions released by the central banks is one of the most widely tracked financial data release, tracked by traders all over the world. The benchmark interest rates are set by the central banks of different countries. These rates influence the retail rates which the financial institutions charge their customers to borrow money, such as the commercial or investment banks. If the economy is underperforming, central banks may lower interest rates to make it cheaper to borrow. If, however, interest rates go down, this may lead to a flight away from the currency as it no longer yields high interests, and therefore investors would look to purchase assets denominated in high-yielding currencies rather than a low-yielding one. This could result in the devaluation of a low-yielding currency. When interest rates go up, it causes an increase in the value of the currency in question, and when they go down, it can lead to a devaluation. Similarly, any other actions or steps taken by the central banks in order to intervene in the markets and influence economic growth can also cause major price movement in the currency markets. An increase in the supply of the currency could result in its devaluation. For example, in the present day scenario, quantitative easing is being used to increase the money supply within an economy through various kinds of asset purchases, such as the mortgage-backed securities or the MBS or government bonds, etc. And this results in the devaluation of the currency. Also, the outlook reports on inflation or the GDP outlook periodically released by central banks could also cause major price action in the currencies involved. Next, we will discuss the various political factors and how they can influence the price action in currency markets. Political situations and natural disasters may act as indirect measures to affect the sentiments and drive the price actions in Forex markets. For example, a big natural disaster which causes a lot of damage may have immediate adverse effects and could cause the currency of the affected nation to devalue immediately. Similarly, changes in the political situation and hence possible changes in their policies again can bring volatile moves in the Forex markets. These include situations of war or unrest, which could cause the oil prices and the value of the currencies of oil-producing countries to increase. Hence, it is very important to be well aware of the happenings in the world, since as a result of globalization, all economies have become interconnected and an event in one has an impact across all the other economies. We have previously discussed the importance, relevance, and the use of technical analysis in our trading. However, even if we base our trading decisions only on technical analysis, it is always better to keep the fundamentals in mind, as they can cause major volatilities and changes at times. Sometimes the changes in the trend may be long-lasting, and sometimes they might just be temporary but very volatile changes, especially before and after any important economic data is released. With this, we come to an end on our tutorials on fundamental analysis. Hope it was of use to you. Thank you again for taking the time to watch this video.